And now it is with great pleasure to introduce and hand things over to CEO Coaching International's CEO and founding partner, Mark Moses.
Good morning, and welcome to What Every CEO Should Know About the 2024 Economic Outlook. If you're a CEO in the midst of annual planning and wondering how the U.S. economic outlook for 2024 will affect your plans as you lead your organization, we hope to provide you with some clarity and perspective as you prepare your leadership team and company for this coming year. I want to say that recessions happen about every 10 years or so, and it's been about 13 years since the end of the global financial crisis in 2010. The world has been talking about a recession since the beginning of the pandemic, yet it still has not happened. Or is it happening? I'm not sure. Our expert, Paul Donovan, will tell us that in just a moment. And many leaders have never experienced a recession, as they may be too young and were still in college when the last one took place. Some leaders may have forgotten how painful it can be. Paul Donovan, Chief Economist for UBS Global Wealth Management, will answer your pressing questions about our economy today. And as we mentioned earlier, if you have your own individual questions, please ask those in the chat. So with that, Paul, welcome.
Thank you, Mark.
I look forward to asking you some questions about the economy. Many of our listeners have written some questions in advance. Many more will ask us questions as we go through this. So what is the state of the economy today?
Well, we've got to consider two things. We've got to consider the economic cycle, so where are we going in terms of the ups and downs of the short term, but we've also got to consider that what we are really just starting on is one of the biggest structural changes in the global economy in 250 years. And so we've got two things happening side by side. So the structural change is what economists call the fourth industrial revolution. And this is about robotics, automation, digitization, social media. The upshot of that is revolutionary. The hint's in the title, fourth industrial revolution. It's revolutionary. It's changing how we work. It's changing where we work. It's changing what we do. It's changing how we consume, where we consume, what we consume. Flexible working, online retail. These are just very obvious examples of the structural change. Now, the challenge is, of course, we've got all of that going on, and that's a 10, 15-year, 20-year process, very disruptive. And then alongside that, we've got the normal ups and downs of the economic cycle. So it's making things actually very, very confused. And one of the biggest problems is that the structural changes are reducing the quality of the economic data. So economic data has become a lot less precise, and that makes it more difficult for me to do my job. So as we go through this webinar, I think it's very important. Please do remember, my forecasts are never wrong. It's always the data that's going to be wrong. My forecasts are right. You've just got to wait for the data to come around to my way of thinking. So, but where are we in the cycle? Now, we've had a really interesting cycle. Obviously, with the post-pandemic environment, very, very peculiar. What we are seeing now is that legendary creature, the soft economic landing. What is happening is there is a slowdown. A lot of the post-pandemic boom has faded away, particularly for durable goods. So washing machines and electronics and furniture, that demand is definitely slowing down. But middle-income consumers, particularly middle-income consumers in the United States, are actually doing better than the data suggests. And that's giving a degree of resilience to demand. So demand is slowing, no question, but it's not collapsing because the middle-income consumer's got a bit more spending firepower, and that's helping things jog along. So what we've got to do really is delve a bit into the detail of the data and say, look, if you're low income, actually things are pretty tough at the moment. You're renting property in the States, for example, it's not looking that great. Your spending power is being eroded. But if you're a homeowner in the United States, actually, well, unless you're in Florida where inflation's quite high, you're in a low inflation environment and your spending power is doing just fine. And we're seeing this in the consumption numbers we had out today from the United States, for example. Never go short the hedonism of the US consumer. They're a resilient bunch and they're carrying on spending.
You opened with something really interesting, Paul, and that is you went back to 250 years. And I don't know who's older, you or me, but let's assume I'm older than you are. I don't remember what was going on 250 years ago. Maybe you got a better memory than I do.
Well, you guys were rebelling against legitimate British authority, and we were going through the first industrial revolution in the United Kingdom. And this was obviously enormously disruptive because that was the end of the agrarian semi-feudal society. And all of a sudden, people are no longer living in villages, they're living in cities. People are no longer working in their cottages, they're going to factories. People are no longer growing their own food, buying locally. It all has got to be shipped in eventually by railways into the cities. Now, what's absolutely fascinating about the fourth industrial revolution is we're reversing a lot of the changes of the first industrial revolution. People are working from home again. More people are self-employed than used to be the case. People are producing more goods locally than has been the case for a couple of hundred years. So actually, the really interesting thing is all of those really dramatic structural changes from the 1750s onwards at the first industrial revolution are now sort of partially, at least, unwinding in the fourth industrial revolution.
You know what, Paul, what I worry about the most is that, look, we have a rising interest rate environment. It jumps so quickly, and that does have an impact on a lot of businesses that depend on borrowing, and even from all the way to the supply chain that depend on borrowing. So interest rates can and will have a material impact on some businesses. I also worry about commercial real estate as we think about our own clients, and especially those that are over 50 years old that are leading their businesses. They are saying, some of them are saying, I demand you as the employee come back to work. And by coming back to work, come back to the office. And employees are pushing back saying, hey, pal, you don't get it. I like to work from home. I like my flexibility. I want to go to the grocery store in the middle of the day. I want to work when I get up at 5:30 in the morning, or I want to work late at night. I want that flexibility. What all of that has done has put a lot of pressure on employers who are carrying big real estate, so these large buildings that are now vastly underutilized. And so I'm saying a lot of things about this transitional shift here: interest rates, the need for commercial real estate, the needs of employees for flexibility, or, hey, look, if, if the economy's not that bad and I got choices of where I can go to work, I don't need to work for you anymore. I can go work for somebody that gives me this flexibility. So then, as an employer, I'm sitting here looking, okay, what do I do with this big building that's costing me a ton? Well, maybe I'm going to downsize and I don't need a big building and I'm going to go more virtual because that's what I need. And then what happens to all these real estate, the commercial real estate guys, or the owners of all these buildings? What happens when all these loans come due and it's time to refinance these? What impact will all that? I know I've said a lot here. Well, with all of that, talk to us about how that's all going to roll downhill and impact the business owner, the banks, especially the U.S. smaller banks in the U.S., the economy and the real estate business.
Well, let's start with the interest rates. So, of course, you're absolutely right. Higher rates are designed to make things more difficult for business. That's why rates are going up. to slow the economy down to reduce inflation pressures. Now, I happen to think that Fed Chair Powell is the worst Fed Chair we've had since Arthur Burns, and that's saying something. And so I think he's gone too far, and I think his policy has added unnecessary volatility, particularly into the fixed income markets. But, leave that to one side, rates were definitely going to go up. It is worth noting that the US economy is less rate sensitive than it used to be. So larger corporations have tended to lock in fixed rate debt at very low rates for very long periods. That means, if you've just borrowed money for 20 years, you don't care what's going on at the Fed today because you're locked in for 20 years at a low rate that you got in 2020 or 2021. US consumers, a consequence of an aging society is fewer people have mortgages. People have paid off their mortgages, and if you do have a mortgage, it's fixed rate. And so again, that of course is helping to keep things contained when we're considering consumer spending. So if you're a business that is subject to rising interest rates, yeah, you've got a negative on your borrowing cost, but the mitigation is that unlike previous cycles, your customer base probably isn't too negatively affected. They're suffering a bit, absolutely, but they're not suffering too much. And we're seeing that in the credit numbers. The credit data in the States is not sort of falling off the edge of a cliff. It's not disastrous. But then we come to the commercial real estate sector, and here we're getting a bit more specific. Now, what has happened? I was talking earlier about this structural change of the fourth industrial revolution. The trend towards working from home was going to happen. It is, in the long term, more efficient for the economy. It's going to increase labor supply. It's going to enhance labor productivity. You're going to be able to employ a wider range of people. You're going to get the best person available for the job because you're not bound by geographic constraints. You're not even bound necessarily by time. Personally, particularly for somebody of my generation, I think hybrid working is probably the way to go. So there's still some interaction in the office, but you don't have everybody in every day. Be that as it may, I think that this is a trend that was going to take place. What has happened is the pandemic rapidly accelerated that trend. And whereas we were looking for a tipping point to gradually emerge, and the UK had already moved down the route of working from home, for example, what happened with the pandemic is that rather than this sort of gradual adjust slowly over time, it's off we go, one big step. So now in the UK, where we have data on this, 44% of the workforce work from home at least part of the week. So almost half the working population are flexibly working. Now, that obviously then has implications for real estate, but it's not universally negative for commercial real estate. Because what I think you are now doing is creating far more of a hierarchy. If you are in a modern office building that was designed to accommodate flexible working, like the UBS office that I'm in at the moment in London, we put this up in 2016 or completed in 2016. It was designed from the word go for flexible working. UBS has had flexible working for a decade. And this sort of office is in hot demand. This is not going to have a problem if UBS doesn't want to lease it out. But in the event that we wanted to lease out a couple of floors, we'd have no trouble doing that, because this is exactly the sort of office space that you want. If you are in some tired office building built in the 1980s, the chances are that the physical environment is not really going to lend itself to sort of the flexible working arrangement so readily, and less in the United States, more in Europe. But I mean, we've got sort of converted 18th century townhouses. I mean, these are no use, absolutely no use. So you've then got this hierarchy of commercial real estate. There is still going to be a need for office space. Not as much as we used to have, maybe, but there is still going to be a need for office space. But it's going to be central prime location and the right sort of building. And that's where you're going to get solid demand. But then you go very quickly into a tail. And I think at some areas, you're going to be saying, well, actually, you know what? This is just never going to be used as an office again. So, demolish it and let's put up an apartment block because demand for housing. The US has got a chronic shortage of housing, for example. UK has the same situation. Europe, parts of Europe do. Go with housing instead of the office space, make better use of the land. And that may be where we go. So this does mean that certain forms of commercial real estate are going to come down in price, are already seeing weakness in price. We're seeing this across developed economies. And that is going to put pressure on, obviously the holders of that real estate. I think it is unlikely to herald a financial system crisis because we've been there, done that. That was 2008. And the regulation that has been put in place, particularly in Europe, in the US, up until President Trump reversed it a few years ago, the regulation that was in place has prevented too much exposure, excessive exposure coming through. And I think it's quite noticeable that if you look at the bank failures that we had in the United States earlier this year, Silicon Valley Bank et al., that wasn't a function of commercial real estate exposure or anything like that. That was a good old-fashioned run on the banks, but run on the banks that was, in the age of Twitter and social media, was magnified, and the regulators, I think, were caught asleep at the wheel because they weren't prepared for the impact of social media on a crisis of confidence in banking. But fundamentally, this wasn't really a sort of a 2008, 2007, 2008 style real estate asset problem that was causing it. I don't want to be naive about this. Falling asset prices have negative consequences for somebody by definition, but I wouldn't say that we're then going to exaggerate that with systemic financial system problems.
So let's go back to the failure of Silicon Valley Bank. I remember that weekend because I remember what happened. I had just gotten out of the mortgage business in 2006, and yeah, I know it was lucky timing. And then when Lehman, Bear, and these failures happened. Now let's move to Silicon Valley Bank. So the government made a decision back then on who to support and who not to support. When I interviewed President Bush, I asked him, why did you choose to bail out some companies and not others? And he said he depended on his people to help guide that decision making. When Silicon Valley Bank happened, I remember that time in 2008. And so I remember saying to my wife that weekend, if the U.S. government doesn't step in before Monday morning to do something, the run on all the small banks would be, it's going to happen. And then the U.S. government stepped in over the weekend, which I believe is the right thing to do. Are we still at risk of small bank, regional bank failures? Is that possible? And this fear of the run on the banks again, a problem? And as business owners, is it still okay to have all our money in our regional bank? Should the money be spread out into a number of banks? Talk to us about that risk, because I remember the phone calls that I was getting over that weekend, and then the lack of FDIC insurance on that. And then even during that time, I learned that every business owner could insure all of their money they had at banks, which I had no clue that was possible, by asking the bank to do that and having a separate agreement with the bank, which blew me away. I didn't even know as a business owner that existed.
So I think what we have had with the regional banks and the bank failures is very interesting. It is the first bank run of the social media era, because 2008, Twitter wasn't there. I mean, no one was going to arrange a bank run over Facebook. That actually, I think, was a profound change, because it really took us back. If you go back to, there was a banking crisis in the 1820s in the UK, where a lot of regional banks failed. And the reason that these banks kept failing was simply runs on the banks caused by a crisis of confidence, that the local gentry would be sitting around their dinner table passing port, and somebody would say, oh, well, I don't really trust the local bank, and I've taken my money out and got it into gold, or I've sent it off to London. And then the following morning, everyone else at the dinner party would be clamoring for their money out. Well, exactly the same thing happened, except you're not sitting around a dinner table passing port. You're on social media exchanging tweets about it. Frankly, the port's more fun in my view, but you do you. And so you get this real crisis of confidence. And I think that is what caught the regulators unaware. And that, I think, I agree with you. This is why the federal government had to step in, because in a crisis of confidence, you've got to declare that backstop. Otherwise, you lose control of the situation very quickly. And it was partly because of the easing of regulation that took place in the Trump administration, which undoubtedly contributed to this. It was a lot less likely to happen in Europe. We did obviously have a problem in Europe, but all European banks follow BIS standards. Only large American banks, at least so far, follow BIS standards, and there was criticism of this. What now has happened, though, is that having stepped in and calmed things down, we have not subsequently seen significant money transfers coming through. The Fed is obviously monitoring this very closely. We have a quarterly report on what's going on with the banking system. We're not getting those money transfers coming through. So after that initial shock, the regional banking system seems to have stabilized, calmed down to a certain extent. And so for now, I think things are okay. Does that mean that regional banks are safe, the government's got their back every time? No, it does not. Because you had a crisis of confidence for which the regulatory system was not prepared. You had sort of this death by rumor type approach. And in that situation, the government had to step in, otherwise it would have just blown up into a global crisis. If you have a problem with an individual bank at some point in the future, then there's no guarantee that an individual bank is going to get that same sort of treatment. So yes, there is a risk. So I think that this now means that depositors, frankly, have to either look for insurance or do a bit of homework. How is your bank regulated? What standards are they following? Do you want to diversify your cash portfolio? Certainly in Europe, there are ways of doing that where you can automatically hold cash split between a number of banks. So maybe that is something that you want to consider. I don't think that there is a systemic problem with the regional banking system in the US. I think it could do with some return to slightly tighter regulatory standards, and it's not often that people who work at banks ask for more regulation, but I think in this particular instance it would not be a bad idea. But I think that what we are seeing at the moment is suggesting that there isn't a problem. We're not getting what was feared back in March, April, which was sort of a mass exit from the regional banks into the big, properly regulated banks. We've not seen that capital flow, and so I think that's introduced an element of calm into the system.
Paul, thank you. Let me move in a different direction, and this is the biggest item that's on the mind of CEOs today. And so, what do you expect the business environment to look like next year? What businesses will be positively and negatively impacted by interest rates? And what are your recommendations? I know you're an economist, and not necessarily leading a business today, but business owners and CEOs want to know what are your recommendations on how to protect one's business? And a final question: what industries do you expect will be hit the hardest?
Okay, so we're in a situation where straight after the pandemic, there was really weird behavior on the part of consumers. Understandable, but extremely unusual. We had in the United States the biggest surge in demand for consumer durable goods that we have seen since 1947, when President Truman ended wartime rationing. And actually, it was sort of very, very similar, because obviously with wartime rationing, you've not been able to spend money, so you've been, as it were, forced to save. Then all of a sudden the restrictions are off and everyone's out charging out to, snap up furniture and redecorate the house and so on and so forth. Same thing post-pandemic. People have been sitting at home forced to save, you lift the restrictions, there's still nervousness about socializing. There's still nervousness about holidays and spending and leisure travel. And let's face it, you've just spent 6 months at home with nothing to do but watch, Downton Abbey on Netflix. What are you going to do as soon as the restrictions are lifted? You're going to go out and buy the biggest television you can find, clearly, because you can't appreciate British aristocracy on a small screen. It's got to be, a big screen TV. So off you go. And we get this phenomenal surge in demand for durable goods. And what has happened since early 2022 is that demand has plateaued in the US, and it's actually fallen a bit in the UK and in Europe. Why? Because you've bought the television, you've spent on the goods, you've redecorated the kitchen. Washing machines are not like iPhones. You don't upgrade every time a new model comes out. So we've actually cannibalized the demand. And I think a lot of the feature of 23, and I think this carries on into 24, is that when we're looking at the manufactured goods sector supplying durable goods, these bigger ticket items to consumers, there, honestly, it's going to feel like a recession because you're not going to get, I think, strength of demand there. Now, yes, you've got this sort of hybrid. So an iPhone, for example, you could argue is almost a fashion item. And so there are certain things where you may see surges of demand. But generally speaking, I think the goods sector is going to be remaining quite soft. We're seeing hints of this in inventory data that's coming through in GDP. In the third quarter, there was a big increase in inventories of goods. On the other hand, I think that there has been, I would argue, a more permanent shift in behavior with regards to spending on having fun. So leisure travel, restaurant dining, drinking out at bars, holidays, concerts, entertainment, that kind of thing. Now, yes, there was also, when we got over the fear of the pandemic, there was naturally a surge there. People wanted to go out and socialize. By no means a unique phenomenon in the United States. It's something we've been seeing across Europe and the UK. But I think that there are additional factors which make this a more lasting adjustment in favor of the service sector. Why am I saying that? Well, one of them actually is flexible working. Because if you've got flexible working, even before the pandemic, when we had far fewer people working flexibly, those that did work flexibly tended to spend more on leisure and socializing. One thing is, if you're working at home, I mean, obviously surrounded by your loving family, and that's great, but you might want to break from them. You might want to go down the bar or the pub in the UK and spend some time away from your loving family at the end of the working day. You might want to go out and socialize because you've been in a less social environment during the day. And you might think, well, I'm not going to go on a flight on a Friday night and come back on a Sunday. I'm not going to take a weekend away because those flights are expensive. But maybe I could go on a Thursday morning and work from my Airbnb on Thursday and Friday and have a great weekend and come back on the Monday morning. Because you're working flexibly, all of a sudden you're starting to get flexibility in terms of your travel plans. Again, something that has been happening pre-pandemic and I think lingers on in what we're seeing now. So my expectation is that we will see still this resilience in leisure travel and in consumer spending there. We will see, I think, the lingering effects of the cannibalization of consumer durable goods demand is going to keep that, let's see, stagnant. I think that's probably a good word to use. It's stable with a slightly negative connotation to it as we go through 2024. Construction varies a great deal from country to country. So, whether you've got infrastructure spending going on, as we've got just announced in China, or as we've got going on in the United States, or whether there is efforts to improve housing construction, as in parts of Europe, some areas you'll see construction spending and the construction sector being buoyed up, even with higher rates, because there is a shortage of housing in the States, there is still demand, there will potentially be some increase in supply. Infrastructure spending a lot less affected by the rate cycle because it's government money that's coming in with the IRA. So I think that that's a more mixed picture. In the US, I think the construction sector probably is somewhat supported by the prospect of infrastructure spending coming through next year. So overall, I would say the simple rule is stagnation when it comes to the goods sector, but I still think, we are going to be going out and spending on having fun. Taylor Swift didn't become a billionaire without that sort of assistance.
So, I mean, very directly, have we been in a recession? Are we going into a recession?
So economists don't like the word recession because there's no proper definition of what a recession is. If we say a recession is a period of significantly below trend growth, no, we have not been in a recession. Absolutely not. The US has been nowhere near a recession. Are we going to go into one? Yes, at some point, obviously, you will have a period of below trend growth. At some point, there'll be policy error or whatever. 2024 probably is not that year. Now, I think the Fed has gone too far on rates, and I think that they will have to start cutting rates next year. But I don't think they've gone so far that they're going to provoke a policy recession. The middle class consumer has got a lot of resilience. I said earlier on, their spending power is particularly strong. And one of the reasons for that is that if you are a middle class US household that owns your own home, your inflation rate today is below 2%. Now, I know the headline says it's 3.7, 3.8, whatever it is, but no, your reality is below 2% because a lot of inflation is made up prices. It's fictional prices. When you look at what you are actually spending, your cost of living, unless you're in Florida, I'm sorry, Florida has just got a bad inflation problem. Most of the rest of the states does not. And you're experiencing inflation about 2%, which means you've got rising real wages. Your wages are rising faster than your inflation is, which means you've got more spending power. Very, very difficult to engineer significantly below trend growth when the middle income consumer is in that situation. They've got reasonable job security, they've got rising real wages, spending power is going up. I don't see it. Now, certain groups in society are going to feel pain, and we have to be sympathetic to that. Lower income groups are not in so fortunate a position. Rents are going up a lot, and you've got to spend on rent. It's not like having a fixed rate mortgage. So that group is in a more severe position. But I mean, it's a sad fact. Economies are plutocratic, not democratic. It's $1, one vote, not one person, one vote. And so that biases you towards the middle and higher income groups when you're talking about overall economic activity.
Correct this statement. What I heard you say is there may be a slowing, there won't be a recession, and I know economists like to dance around that topic. So this fear mongering around a recession is, and you're saying this is not going to happen. Interest rates, we've gone too far, likely to start coming back down to normalize would happen very quickly. And some industries are going to get hit harder, but most industries will just carry on. Am I articulating what you said
that's
closely? Close?
The one slight caveat, because economists must have a caveat somewhere. So the one slight caveat in the States, I've mentioned Florida a couple of times and their unusual inflation story. That's actually now become quite typical of the United States, that the divergence of experience within the United States has increased. So for the economy as a whole, I think no recession. If you are, let's take an extreme example. If you are a manufacturer of durable goods, predominantly selling to low-income households, and you are in the wrong part of the United States, it's probably going to be a recession. But this is we're sort of narrowing down very, very much. There is more geographic divergence in the United States than has been the case historically. So we're seeing more divergence in terms of certainly inflation, to a lesser extent employment and economic activity. There is that divergence. And so when I'm talking at the macro level, I'm pretty confident that in the next 12 months, we're probably not going to get massively below trend growth unless there is some kind of awful catastrophe, exogenous shock type situation. But the regional divergence is very interesting. We've also seen this in the Eurozone, where there has also been regional divergence taking place, a little bit less actually than in the United States of late. But just bear that caveat in mind that overall, I don't think we go down this route, but in certain locations you will. And honestly, you're starting to see this reflected in the politics and the polling ahead of 2024, that both candidates, both parties are going to have problems campaigning on the election at a national level, because obviously President Biden's going to want to say everything's fantastic, but maybe it's not in Wisconsin. And former President Trump's going to want to say everything's terrible. Well, actually, maybe it's not in New York, and that's going to be the difficulty that comes out of this rather peculiar economic situation.
So these are very unusual times. Let's take two situations that take the Israeli war right now, and then take the ongoing war between Russia and the Ukraine. Take those. I know they're very separate from each other. What impact could either of those, and probably what's on most people's minds today, is the impact of the war in Israel today? What impact will that have on the economy and on people today?
So it is the job of an economist to be very clinical about these things. In both cases, humanitarian disasters, terrible loss of life, and so on. Economically, it comes down to oil and gas in both cases. And so the question is, the Israeli economy, certainly Russia, Ukraine, the wider Gulf economy, in the global scheme of things, does not matter that much, except as a producer of energy, and in the case of Ukraine, also some agriculture. So the question is, do you have a situation which is significantly different from what energy markets are pricing today? And I would contend that energy markets are pricing certainly a continuation of the Israel-Hamas war, certainly a continuation of the Russia-Ukraine situation, but they are not pricing in an escalation that would, for example, involve major military action against Iran. That is not in the price, I think. So if we see an invasion of Gaza, for example, if the sort of creeping withdrawal of Russia in Ukraine continues at a relatively slow pace, then you are going to continue to see energy prices more or less around current levels, and the economic disruption from that is minimal. This is within trading ranges. It's not something which is going to create a great deal of economic damage. If you were to see an escalation of either conflict, so Russia, Ukraine, what has been talked about is, and hopefully it will never happen, but an escalation involving battlefield nuclear weapons, for example. In the case of Israel, Hamas, it would be something bringing, I think probably bringing in Iran into the equation. I'm not sure that the actions with Hezbollah and Lebanon would be seen as enough of an escalation. Lebanon obviously does not produce oil and so on. So that would then be the next level. That would, I think, be a growth negative shock. When we had the invasion of Ukraine by Russia, that was actually a price inflation shock more than it was a growth deflation shock, because essentially what happened was energy consumers still had enough spare cash that they could afford to pay the higher prices. But a year on from that, the cash stockpiles have not disappeared, but they have dwindled. And so energy consumers would struggle to pay a higher energy price. And so therefore they would cut back more aggressively on consumption, and that would then be a growth deflation shock. Obviously, you get inflation of prices as well, but I'm saying that this time the growth impact would be the bigger impact not the price impact. There is also a longer term consideration that comes out of both of these conflicts, which actually started and I think has been driven primarily by the Russia-Ukraine war, which is the question about, have we lost the peace dividend? Are we going to be seeing a permanent increase in military spending going forward? And of course, it's not just the Russia-Ukraine or the situation in the broader Middle East. We've also got the situation in the South China Sea. There's plenty of potential for conflict. I'm afraid one of the consequences of structural change in an economic sense is very often the rise of economic nationalism, which then very quickly triggers into overt nationalism, and increased military spending is very often part and parcel of that. So I think that one of the longer term considerations is that there will be more pressure to increase defense spending, military spending generally, and that's going to present more challenges for government. Ultimately, I think we end up with government playing a larger role in economies in the next 15 years than they've done in the last 20, 30 years. Defense will be part of that equation.
Final question. What advice would you, as the chief economist at UBS, give a CEO today as they navigate their plans for 2024 heading into the environment you just talked about? What advice would you give them?
So I think the number one starting point is pay more attention to your business than to CNN or Fox News or social media. You know your business better than the media environment. The media environment is sensationalizing economic data that is not accurate. So, if you're hearing all the time, the economy is booming, and actually you're seeing sales fall, well, perhaps you're in the wrong place at the wrong time, and you need to extrapolate from what you're experiencing and not get carried away with the macro picture. Economics is not precise, but we're in a world of soundbite economics where and I do a lot of media work, and they always try and sensationalize what you say. It's, you were predicting 3.2 and it's coming at 3.1. Recession must be happening tomorrow. And it's, what? This is a rounding error. So you just bear in mind that and trust your instincts. I think that's the most important point. Secondly, I think prepare.
Oh, please go ahead.
Sorry. Secondly, I think prepare for the structural change. You cannot stand like King Canute holding back the tide of change. Change is coming, and it's big, and it's dramatic, and it's scary. But I think as long as you try and ensure that you have the right people in place, right person, right job, right time is the absolute mantra for success in the next 20 years. Put in place the right people who are flexible, who've got the right way of thinking, who may challenge your way of thinking. I mean, I have this all the time. I encourage my economists to disagree with me and challenge my ideas. And damn it, they do. It's infuriating. But it also makes for better quality decision making, and particularly at a time of structural change. So that I think we need to do. Sorry, I have forgotten we've got a fire alarm test, but it will be over shortly.
Please take note.
You know what? Why don't you put yourself on mute, and I will summarize what I heard you say. So I heard you say we do not need to worry about a recession. There's a lot of hype in the media that goes after sound bites, and it's sensationalized how we feel. We got to worry about our own businesses and determine what success is for us, and determine the few things in our business that we have control over in our own business that will drive the outcome that we want. Ensure we got the absolute best people in our seats, in our companies to drive the outcomes that we want, recognizing that the world is changing, but nobody knows our business as well as we do. Stop with the fear about what's going on all over the world. Focus on our own businesses, what we have control over. We know our businesses better than anybody knows our businesses, and find a way to continue to grow and take market share the way we've always competed, or new ways to compete in the environment today. But that's what I heard you say. hopefully the fire alarm didn't, you didn't get to miss my summary here.
No, I did. I got it all, and I agree. I think that's a very good summary. I think the guiding principle: trust your instincts, but be receptive to being challenged. That's probably the best approach in this time. It's a fantastic time to be an economist. It's a really exciting time in the global economy, and I think the next 15, 20 years are going to throw up huge, wonderful opportunities. But the downside of that is with opportunity also comes risk. So you need to be prepared for both.
I got to say, it's much more interesting talking to an economist now. And when I was in college, I didn't really get it. As a business owner today, it makes a lot more sense to me. Paul Donovan, Chief Economist from UBS Wealth Management, thank you for being here today and sharing with our community your perspective on what's going on in the world today economically and your perspective and suggestions on 2024 and beyond. Thank you. We appreciate you.
Thank you very much for your time.